Okay. And we're done. Okay, good morning, everyone, and welcome to a new episode of the Crypto Hour. Today, I've got kind of like a debt special to talk to you about. Seconds. Somebody got them. I don't know why. Do I hear? Do I hear myself twice? Oh yeah. Okay. Close YouTube now. Oh my. Okay, problem solved. Technical problem solved. I was saying today I've got like a debt special to talk to you about, because I think this is the biggest problem that we face nowadays, more than inflation and anything else. The contrast of the debt market compared to the stock market and any other market in the world is very stark. So we are talking to about trillion compared to billions. So it's an order of magnitude bigger than anything else that we can imagine. Okay, so let me go through, and I prepared a little presentation for you, so at least we can go through it together, because it's quite a dense subject. But I'll try to make it as simple as possible, so we can all understand, and we can all understand what the consequences will be. Okay, so let me go on to PowerPoint. Okay, wait a second. Sorry. Okay, can you, oops, sorry. Can you all see the screen? Yeah, perfect. So here we need to go a little bit deep, in the sense that talking about economic growth in general, which is driven by, generally speaking, by demographics and productivity. It's something that two things that peaked in the 1980s. Okay, so as then these factors change over time, the problem that how we dealt with this problem is basically we're just issuing debt. Okay, and lots of it as well, because as the working as people started getting older, and productivity started going down, obviously we finance it with lots of debt. So it worked until pretty much until now, but we are kind of this debt cycle goes in very long term. Okay, and normally, let's say, a growing population, so high fertility rates, facilitate obviously growing labor force. And generally speaking, across the world, many countries don't have a pension fund, pensions they are funded, but they are generally funded by the working population. So as then the new young workers get less and less compared to people that draw their pension, the opposite happens than what would happen in a normal healthy economy, as the more young workers enter the working population, and those support the people that are going outside the working age and started to draw their pension. So generally speaking, more workers equals more potential for growth. Now we are facing a demographic like seismic change now in the world, and over the next 15-20 years, we will see that the working age population will decline across many industrialized countries. Just as an example, is estimated the Chinese workforce will shrink by about 250 to 30 millions over the next 20 years. Okay, so we'll see here in this image the working age population across different countries. As you can see, in the 1980s, the percentage of working age population compared to total population peaked. And different countries, it was obviously different from 70% here to 65, between 65 and 70% roughly. And it started, oops. Oh, come on, don't do this. It started declining in the 90s and beginning of the year 2000s. And we can see now what the estimations are going to 2040, 2050. That even the highest, in the country where the working population is highest, will only be about 60% compared to 70% of about 30, 40 years ago. And with some countries, the countries that got a more aging population, like Japan and Italy, for example, being just about 50%. So can you imagine that this is a big burden? If you're thinking about the 50% is the population that is working, means that there's another 50% of population that is not working and needs to be supported by the working population. Okay, and these are data, by the way, from the World Bank. I'm not making up these numbers. Okay, so now if we go into the productivity, this total factor of productivity measures how productive are capital and labor, because you need both capital and labor to enable to create productivity, improvement in productivity. Now, so effective when capital allocation and technological process work together, these then achieve positive growth in productivity for the country, and those countries become generally richer. Okay, so richer across the board. We're not talking about distribution of wealth, but generally speaking, those countries that can achieve that become richer. Now, there's a marginal benefit for technological progress. So it gets, as it gets more and more, the actual improvement of the situation we had the year before and the year before that becomes smaller and smaller. And also we need to factor in this capital misallocation that started taking place from the 80s. And really, strictly speaking, just want you to understand. Now, I know that I keep going about it pretty much every time we talk, but it's 1971 is when the world went off the gold standard. And one thing, if you listen to the Austrian School of Economics, what the gold standard enables is proper allocation of resources. Okay, because the resources go where there are products that people want, when there are services that people want. Where with the fiat money, the biggest problem in it is that resources go where the governments want, not where you want. Okay, and that creates over time a misallocation of capital in the wrong places. Okay, and it is a kind of like it's a small, like a drip effect, which nonetheless becomes compounds over a year. So this total factor productivity stagnated until from the when it peaked in the 1980s to the recent day, it stagnated around 1% per year. It's not really exciting. So have a look at this figure here, and it shows the different productivity. So this is the orange bar is the most important one. This is the total factor productivity. So we can see the average was between 1.5% and 2% for many decades. It peaked obviously just after the war, but then in the 1960s and 1970s was still fairly elevated, and then actually now from the 90s it started declining again, where we just about at 1% growth per year, which is really not enough to sustain our growing economies. So these trends from the end of the 80s weakened a lot. So, and when the GDP growth declined to levels that were frankly unacceptable socially and politically, we fixed that again with a ton of debt. Okay, so translating into simple words, people got used to a certain standard of living, and nobody likes to hear, actually we need to cut back. We can't afford this. We need to, go without for a few years until we are back on level terms. And so if you can understand this on a normal household budget, where we are used to, if we can, trying to spend no more than what we earn. If we spend more, then we accumulate debt. So it could be, a mortgage debt. It could be credit card debt. It could be loan debts. So on a simple household economy, it's easy to understand. Now, the difference. Sorry. Why do I? Okay, the difference, so we see this in a national economy. We can see the percentage of debt compared to GDP. Okay, and what it was kind of like, below 200% to over 300% in less than 2 decades, and in China from 100 to 300% in 15 years. Now, this is from the Bank of International Settlements. This is the growth, low yield. Why can't we have real interest rates that are very low? Because we had a system with low structural growth. Okay, so the only way you can sustain a system with low productivity, there must be low real yields. Kind of like, because otherwise, people invest in debt in a way, buying bonds and so on, to get a return, but also, these returns are paid by the productivity. So if the productivity is not there, and we have to pay for debt more than what we produce by employing the money that we borrow, there is a problem. Okay, can you see that? So if the productivity is low, then interest rates must be low as well, otherwise the system breaks. Now, as you can see here, a world that can actually swim in debt can't sustain higher real yields. Okay, so we see here on the blue line, this is the the US 30-year 30-year notes real yields. So, and we can see that they've gone from, they almost, I'm not saying they are doubled, but almost doubled in this time frame. You can see from the early 2000 to where we are now. Okay, so this is a very long-term debt, and the thing is that the Fed can and in a lot of ways it controls the short-term maturities, like they can influence very heavily the 2-year debt that the US has, but they can't control the long-term debt because it's just far too big for them to influence. So this is the 20 and 30 years debt in the US is controlled by the market. It is what the market expects as well. And the orange line is the debt as a percentage of GDP. Oops, sorry, keep going into, sorry. As a percentage of GDP, as you can see, it's been getting, again, a larger proportion of a gross domestic product. Now, this is a long-term debt cycle that on its very last legs. Okay, so you hear central bankers across the world talking about fighting inflation and having to raise interest rates, to be able to control inflation. But what is the problem? The problem is the mountain of debt they have accumulated. If they raise interest rates, it doesn't mean that we pay more on our mortgages. It also means that they have to pay more interest to whoever is lending money. Okay, and that is a problem as well. So to deleverage a system, a credit-based system, it's very hard to do and still maintain the economy growing. Look at Japan. Japan has been deleveraging for over 20 years now, and this economy is not back to what it was at the end of last century. And it's still struggling to get back to that level, and not being very successful, to be honest with you. So this is what happens, and you can understand this if you compare it to your household budget. Okay, so this is the money coming in, the revenue. So obviously this is for the country, okay, for the US. We're talking about almost 5 trillion in tax revenue. Okay, and then there's the deficit. It's called deficit because basically you are spending more than what's coming in. So just think about it. If you earn, whatever X amount and you spend X plus 20%, X plus 30%, then you have a problem, because you need to find the money to finance that difference. You see, the difference between spending and income, revenue, is the deficit. So this is the amount that is missing every year. Okay, and although it's kind of this sum, it doesn't seem that big because the American economy is much larger than this. Again, this amount doesn't just disappear, and it accumulates every year, accumulates and accumulates. And this is the amount, when all pulled together, that the US has got to finance, through bonds. And so this is the amount on which they have to pay interest to third parties. Okay, so you see the problem now. When interest rates go up, the amount they have to find to finance, not the deficit, this is just a 1 year deficit, but the deficit that has accumulated over many years, it's a growing problem. So obviously a government has got more weapons to be able to fight this imbalance than an individual. Okay, but the problem is, it's not this, it's just the lack of urgency. Obviously, nobody likes, no government in power likes to talk about, or government or opposition never, don't like talking about budget deficits, because there are other problems that take people's interest a lot more. People like to hear how their life is going to get better. They don't like to hear how their life is going to get worse first before it gets better afterwards. So it becomes a normal for the US to normalize this multi-trillion-dollar annual deficit over the last few decades. Now, this is maybe kind of like it's difficult to comprehend on a level. Okay, so I just want to bring you back to when you see here the 40s, the 50s, and 60s, and beginning of the 70s. Why these amounts are very, very small? Can you see this? And the reason why these columns are very small is because we were in a gold-based system. Okay, so what happens in a monetary system that is backed by gold is that generally the budget is at equilibrium. You can only spend the money that you get in. So you need to tax people, get in the revenue, and then you can spend it. You can't spend money that you haven't got. The only reason why there is a deficit sometimes here is when countries were financing particular public works, building railways, bridges, and big projects. So on these cases, obviously, they couldn't raise all the money beforehand, but they borrowed and then paid it back over a number of years. Okay, sorry, where am I? Over a number of years. So see what happens after the US went off the gold standards. So each year it became, they got used to spending more and more. What is all these gray bars? This is just money that they haven't got. Okay, so and each year, obviously, as you can see, very rarely these bars actually get smaller. And there's only a period of 4 years when the US actually earned more than it spent over a 50-year history. Okay, and you can see now, so this is how, you can see here, these long bars, this is how the crisis of 2008 was financed. And these latest bars is how the pandemic was financed. Okay, these are kind of like really, really large numbers that for many countries represents, if it wasn't the US, this will represent huge numbers that many countries couldn't really face and would go bankrupt for. Now, so for almost every year in the modern era, the US has spent more money than it took in via taxes. Okay, so this is called deficit spending. Now, nobody worries about this because everybody thinks, well, the money needs to come from somewhere. I've got money in my pocket, so what's the problem? So this is not new, by the way. This is what the Romans used to do, when they call the panem et circenses. So we can basically give people bread in their belly and some circus acts to entertain them, and then they're happy. They won't come and worry the politicians too much and start asking questions that they wouldn't like to answer. So, but the problem is that these deficits don't just disappear on New Year's Eve, when the new year comes in. So the deficit is a 1 year change to the national debt. So it means it's 1 year when you spend more than you earned. But each year, if you do that, that accumulates and becomes, accumulates in the national debt, which for the US is very large. So obviously it creates then a bigger image than the normal 1 trillion annual deficit when they do the budget every year, and they go, all these issues about agreeing a budget in Parliament and so on. So how do you like this figure? You see, it's hard to comprehend, isn't it? So these are the levels of national debt that we had in 50s, 60s, and 70s. Oops. Sorry. And this is how the national debt has grown over time. Even during the crisis of 2008, we were only about $8 trillion, okay, of national debt. And now we're approaching, so this data was at the end of 2022. So by now we actually over 32 trillion of U. So what does that mean? Okay, these are just numbers. Okay, so what do they mean? So this is the problem. Okay, since the Second World War, the rest of the world has been happy to use the American dollar, as the world currency. Okay, so to lend American money in exchanges for a little bit of interest, as that debt is being repaid. Okay, that worked okay for everyone, as long as America is considered as the world superpower, okay, with the largest economy in the world. The problem is that Americans actually got accustomed to cheap and easy debt, and they kind of like live beyond their means year after year. Now they're running over 1 trillion in additional debt every year, like it's no big deal. Now, the only problem here is that over time, and this is in history, we're looking at all the long-term empires come to an end at some stage. Okay, so superpowers slowly lose their primacy. Oops, sorry. So when a superpower borrows too much, there are a few things that happen. First, their financial position gets worse. So they have a lot of debt, like we're seeing right now. So then people and countries begin to view them as higher risk borrowers. So they ask for more money in exchange for lending, for lending the money. So then these countries have to spend more on interest expense. So now that they have higher interest rate debt. And so what happens? They have to print even more money to pay the other interest expense. So making all of this incrementally worse, little by little. Now, and this is why since the 1800s, 51 out of 52 cases where a country's debt to GDP ratio reached 130%, the country eventually defaulted on its debt. The only exception to this is Japan, who is really at the last stages. So we are now the central bank is purchasing assets and they control the yield curve. So it's not actually a good example to follow. Now, who wants to guess what the US is now? What's the debt is as a percentage of GDP? Now, don't Google it, please.
210.
Anybody would like to? Sorry, I can't see the chat box while I'm sharing my screen. So if you want to guess, just tell me. Just unmute yourself and say.
200%.
400%.
No, 400%. I think we all be
Yeah.
we will be kind of digging in our garden and trying to grow vegetables.
128%.
That was very, very close, Kim. So the level at the moment, and this is from the White House itself, 129%. Okay, percentage of debt to GDP. So it's quite, it's quite shocking. But we are at those levels now, levels where, nobody has successfully come out of these situations before. And this is another thing from, again, from official sources. This is their projection. Okay, so where they are now, it's at about, 129%. And now they expect this debt to grow without, linearly, without any problem. So they expect, in 2050 or 60 to have 400% of the national GDP financed by public debt. Okay. So, just ask me, are you comfortable? You think that this is normal and this is what is going to happen without any issues here in such a nice linear growth like this? I mean, we are seeing the first sign of it now, that people are not happy with it. So what are the two ways normally that the governments can get themselves out of this issue? One thing is simple: spending cuts. Kind of like, well, spend less than what comes in. Okay, so if you have your tax revenues, can you spend less than comes in? And this is the answer. So this is the federal spending in the US. As you can see, it doesn't get less. There's only this decline here, simply because the 2020 was an exceptional year because of the pandemic. So we're spending less now than 2020. But but compare it to what came before the pandemic, and you see that these numbers are huge. And so the other thing, so one way is spending cuts. What's the other way? What's the other way of reducing the debt?
Raise taxes, but they'll never do it.
Exactly that. So that's the thing. That's the other way. It's higher taxes. And just realize that before 1913, which is, again, can be considered like the birth of the modern fiat money. In some way, they're going to go, in and out until the Second World War. The income tax was only for the rich, and even the rich were taxed between 1% and 6%. Okay, and this is what went on, as you can see, in the money that was was spent, and you can see the gray area is the overspending over the revenue. And there's only like for these are the 4 years when actually there were more revenues than spending. Okay, which is a kind of a real rare occurrence. And every year, as you can say, this gap has got wider and wider and wider, because not only they're spending more because they keep over promising to people what they can have, because, as I say, no politician will be re-elected if they don't improve the living conditions of the people that want the vote from. So so that's the kind of like the end of this kind of like tour de force over tax and spending. But the situation is that and this is, by the way, this is the US. Do you think that the other countries are in a better situation? Many countries have got the highest debt to GDP ratio that they had in the history. And the other thing is, I know that you probably might have heard that this thing of the world de-dollarization. Okay, so in a way of people going to a different world currency, like the BRIC currency, that's been talked about. Now, although it's a nice story, at the moment we see no signs that could actually be achieved. because the problem is that all that debt that we see, a big chunk of it is owned by other countries. So over 12 trillion is actually owned outside of the US. So being able to move to a different currency, first of all, there's no other currency, no other system that's got even anywhere near the liquidity of the US debt market. Because if you are thinking about, this is kind of like 12 trillion, but if you want to lend money, you want to make sure that you can get it back when you need it. Okay, and at these levels, there's no other market that compares. So not the Japanese debt market, not the European one, nowhere in the world. And I mean, and there is a very big problem even for the BRIC countries that would like to have a different system or a different currency that to exchange value from, is they will need to deleverage themselves, and that will cause huge problems to the business system that to find the dollars to repay all the debt and all the papers that they hold. It's a huge logistical problem, and this is why there has been a lot of talk now for decades over replacing the dollar as a world currency. But why nobody has done it yet is because it is not easy to do. It's not a simple subject. So you know how this is going to play out. Then we can have an interesting conversation. But what is looking more likely, it's hyperinflation. It's hyperinflation. So in a way, because they can't, there's no way they can pay back their debt. Just impossible at this level. Now we are way past by a few years the point of no return. Okay, so these are evident. And in particular, as you know, we have now a huge banking problem. There has been accumulated because of this debt issue. Because banks again have been borrowing, funds to invest at short-term rates, and then they invest them at long-term rates. And generally speaking, the long-term rates have always been, higher than the short-term rates. So that difference made their profit. But what happens now is that the short-term rates are much higher than the long-term rates. So there is a huge problem for a lot of banks. And in particular, for me, the biggest problem, the elephant in the room at the moment, is the American regional bank sector. Okay, because it is of a size that is considered small. From the US, that means that the control over them are very, very lax. Okay, and they don't do stress testing as they're forced to do in Europe. Okay, below 250 billion, they don't do any stress testing. So what are they? So if we think about the regional banks, which are the ones under threat right now, what are they investing in? What's the biggest investment? Is in the US commercial real estate. So if any of you from the US take a walk into a business district in the US and tell me if the commercial real estate sector is a full capacity or not, or if they go empty offices. Okay, so and what I'm telling you, what my idea is that the commercial real estate sector in the US, it's on its knees, and that would bring down a large number of regional banks. Now, how the US deals with this remains to be seen, because so far, whenever when there have been banking crises a few weeks ago, they come out and said, oh, we guarantee everything, we guarantee all the deposits and everything. Now, the problem is that there isn't enough budget to do that, because the banking sector as a whole, it's huge, and it's even a lot bigger than the security deposits that are in place they were put in place to deal with the exceptional cases. Now, if the exceptional cases become the norm, there isn't enough in the whole US economy that could cover the black hole. So, you say, where are the where is our savior? And obviously, I don't have the correct answer for you. I mean, from my personal impression is that, you know, the money itself is just a tool. It's a tool that makes trade easier. Okay, so where money, the value of money itself, it's a market good that changes value. And so this is what we're observing. We're observing that this good that's called money is changing in value. You know, it's becoming less valuable. But the thing is that the things that the money buys, so the real economy, so, you know, you buy food, you buy services, you buy what you need for day-to-day living. You know, you still need to live in a house, whether the dollar is worth, you know, X amount or is worth 10% of that amount. You still need the same place to live in. You still need to buy food. You still need to, you know, to do everything that you do every day. So the assets that are real are the ones that will keep their value over time, because there is a real need for people to have them in their life. Okay, what is changing is that, you know, and that's what we're seeing in the UK, because for example, the housing market in the UK has been very buoyant for the last, you know, 25, 30 years plus. And we have people that were still living in a family home, maybe like a, you know, 2 up, 2 down, what we describe here in the UK, just a normal terrace house, you know, 2-bedroom, two reception room downstairs, bathroom and kitchen. Okay, the standard living, which was the standard in the UK for many families. Now, in certain parts, especially around London, you know, owners of a house like that, they have owned the house for 50 years plus, are now considered millionaires. Now, is their standard of living changed? Are they now richer than they were 50 years ago? Absolutely not. Absolutely not. But they now have an asset that, you know, it costs them maybe a few £1,000 to buy, and now is valued at 1.5, maybe 1.5 million. Okay, what has changed in this time? The house is the same house. It houses the same number of people. Yes, maybe the demand for housing has changed because there are more people. So there is some increase, like from the society point of view, the house is a bit more desirable than it was 50 years ago. You know, but it is not justified seeing like 40, 50 times growth in the value of a house. So what has changed is the value of the money that is used to purchase it. Okay, so that's the very important thing. If you want to understand if your wealth is going up or going down, just a very simple measure. Just divide your wealth by the price of gold in your country. Okay, and so if, you know, this year compared to last year, you would have, if you converted your wealth to gold, if you had more gold than you had last year, then it means that your wealth has gone up. If you have less, your wealth has gone down. As simple as that, because that will take away because gold is a scarce item that cannot just be printed. So there is a limited amount of gold in circulation. It's basically, it's considered as a constant, although gold has got some inflation as well. But comparing it, that takes away the inflation from the numbers that we use to calculate our wealth, because I say, as we can, you know, I've shown you the dollar value is not reliable. It's not a reliable measure. Okay, and that's one of the three characteristics of money. There should be a unit of account. Okay, and also it should be stable over time. Now, as you can see, in generally speaking, not just the dollar, but most fiat currencies are not able to, you know, to be used for that function anymore. Okay, so in terms of what I see coming, and I don't know which format this will take. Okay, I honestly, I don't know. If anybody tells you that they know, I mean, it's just a more or less educated guess. But what I can see, kind of like high level, I can see a decoupling of the management of the economy in general, or the management of, I would say, value exchange, not so much the economy. The management of value exchange should be taken away from governments. Okay, so, and this is, by the way, is not something, it's no different from what was in place before the last century. Because if you look at the Renaissance, for example, you know, the middle of the millennium, this is what spurred probably one of the richest period in the world's growth that the world have ever seen, was the Florentine florint, okay, which was a minted coin, gold coin. They had some standard, so it had a specific weight that you could rely on. Again, was used all over Europe, for international trade, and that was the if you look at the richest countries and richest empires in the world, is where they kept the value of money stable. So that was, for example, if you look at the Roman Empire, and you can connect the fall of the Roman Empire to the devaluation of the amount of gold that they had in their coins. Okay, where the Roman Empire fell in 400 and whatever, I think it was 473, something like that, AD, its eastern version went on for another 1,000 years. And the reason why that happened, was mainly due to the fact that they kept the Roman solidus, the Roman gold coin, stable for 1,000 years. And that's still going on to these days, because the dinar, the gold dinar, is still based on the solidus, on the Roman gold coin. So if that is a coin that's gone on for over 1,000 years, 1,500 actually, and is still used to this day. Okay, what happened in the 1800s? All countries in Europe, although they had their own currency, these currency were based on gold. So there was no exchange rate to talk about. The exchange rate was just the difference in the weight of gold in the coins. Okay, so we had an international currency that we used to trade with. We used for trading in the 1800s until 1913. And again, in modern times, that is the period where we had the highest productivity growth, and also we had the highest wealth creation. And the wealth creation, they had differently distributed from what we see now. So it affected everybody from the bottom up. Okay, so not just the richest got richer, but the poorest got richer as well. The living conditions improved. Where if we look at the last 50 years, after we went off the gold standard, we see the top 10% and earning more as a percentage of the world, the country's population, and the bottom 10% and less. So that spread has actually widened in the past. So this is what the numbers are telling us. So for me, what we'll see, I don't know, it's not being at the moment, is not possible to actually predict, but exactly. I can only tell you that the biggest difference will be, will people come take to the streets or not? Because this is the thing, would people be happy to let the government sort the problem for them, or will they be taking it upon themselves to create a new system? This is the reason why Bitcoin was created in the first place. And for me, what Bitcoin and other currencies that have a similar monetary policy like Bitcoin, what they represent is absolute scarcity. Okay, where gold is a relative scarcity, because it's not that because there is a lot of gold in the ground, it's just that we don't have the technology to take it out at a good cost. Okay, but if the technology improves, then we'd be able to get more gold out of the ground. So the inflation of gold is not fixed. Okay, so there is a gold inflation every year, but that could get, let's say, worse if we found some ways to get gold out of the ground cheaper and more effectively. So in the case of Bitcoin, instead, we have absolute scarcity, because it's a financial system that is rule based rather than based on unknowns. Okay, where even the gold system has got some percentage of that. So we have basically a technological solution which could replace, could create, I would say not replace gold in that sense, but could provide an alternative solution to gold when the financial system that we're in, ends up collapsing. And that I believe that I'll see that in my lifetime. Probably in the next 10 to 15 years, we might see a redefinition of, at least they will try to really redefine the meaning of money. And that's the only way they can maybe try to get out of this way. And I personally don't think they'll be successful. But this is, say, the real alternative now is a technological one. And so crypto and Bitcoin, and this is, I know that it's been a long-winded process, you know, talking to you about this today, but just I want everybody to understand why we're talking about crypto every week. And because at the moment it's a tiny percentage of the world economy. And again, it's a tiny percentage of people that get engaged with it. But what it could represent, it's huge. Whether it will or not remains to be seen. And it still should be considered at the moment like an early stage, you know, investment. But this is what it could represent in the future. And so this is why so many people are talking about it, because it could represent a change of the way we live and the way we do things that has never been seen before. Okay, so I think I talked enough today. There's no point really talking about anything specific crypto. We'll talk about it next week. More crypto specific, but I think it's important to understand the context, because that means a lot, you know, in this world. Okay, do we have questions? Okay. That's an interesting question. Can you go to war with a country that you owe money to and wipe off the debt? Well, that would be pretty much the US would have to go to war against the rest of the world. Well, that's not going to happen. That's another question. How much is the interest per year on the 32 trillion? Now, long-term interest in the US is about 3.2% at the moment. But short-term interest is over 5%. So you can work it out. You know, so that's the problem. Why the problem that the central bankers are facing is that they will need to raise to raise interest rates to curb inflation. That means that they need to print more money to do that. Okay, so they print more money that is inflationary. You know, so the very crude weapons that they have that don't work anymore. And this is what, by the way, guys, I mean, if you're really interested to know more about this, get yourself go in the just Google the Austrian School of Economics and read some of their work. You know, there are many proponents of the kind of like the gold standard in there. And if you understand, I mean, I've had the luck or unluckiness, I would say, to study economics. And unfortunately, what the economics they are taught in university are Keynesian economics. And the funny thing is that Keynesian was not an economist. You know, so we have been taught economics, which is simply the economics that the governments want you to learn, because it's a system that keeps the status quo, keeps them being able to borrow money without asking you first. And actually spend money before asking you first. And this is the whole reason why the fiat system was invented. No other reason. There are no projects to create something good. It was simply a greedy way of spending money without approval first. If people don't trade in US dollars but rubles and yuan, what happens? There aren't enough around to be able to do that, because talking of the quantity itself that is needed to be able to do that is, first of all, they will need to replace the dollars with this currency. And who would want to, I mean, would you accept payment in rubles, on yuans? They highly controlled currency that can be you know, changed at a whim. You know, but whatever you might say about the US, you know, the US dollar, it is a democratic system. You know, and yes, you know, there is a problem with that, but it's more or less it's beyond the US now. It's a world issue. So this is why they'll need to come up with, you know, some other solution. And if that solution may even be that kind of like a world currency is created that replaces the dollar, but it cannot be done by another currency taking its place. It will need to be, a real worldwide project, and I don't know if that's possible, to be honest with you. Inflation will erode the debt. Yes, obviously. If you just think about it, if you buy a house and the price of the house is, I don't know, $5,000, when wages are maybe the average wages are $1,000 per year. So going back many years. So if you still now own $5,000, but wages are an average of $40,000 per year, then that debt is much less, is more manageable. So, and this is what they I mean, it's not that they were planning to do, but it's what markets will do, because the debt will attract more and more yield to be sustained, and that yield must come from somewhere. So, and I can't see consumption of taxes changing dramatically in the US, because that would be a political disaster. Politically, wouldn't be able to be sustained. That you will see already what happens in the recent history with the election of Trump. Why do you think that happens? Because people are not happy. People are not happy with what they have. People are not happy with their life condition. More than 50% of US population is living on a breadline. So, and that's the reality. So what happens is that those are the conditions that foster the growth of, dictatorships. I don't want to mention any particular dictatorship here, but those are the dictators usually are very popular because who don't like them is the people who can think for themselves. Generally speaking, those are a small proportion of any country's population. And what dictators do, they give away. They do a lot of giveaways to the poorest part, poorer, but also more with more numbers, side part of the population. Okay, so the largest part of the population, they would give away, land, give away money. So that part of the population is happy and will give them the votes to continue being a dictator. The ex-ruling class, the elite will not be happy, but they will not have the strength to fight a dictatorship that has got this big. This is just to give you a modern day example. This is what happens in Iran, where the ruling class is always very popular, because it's not popular in the cities, but they're popular in the countryside, because they brought people that didn't have electric light, they didn't have running water. Now they do have it. So they say, well, I don't care. I had this. I didn't have it before. So I keep giving them the chance to, to carry on in power. Yeah. So yeah, a big and hard, I think, lesson to digest today. But that's the reality. How do governments manipulate the value of gold and silver in the current moment to support the control of fiat control? What they do is use derivatives. So they artificially keep the the price of gold and silver down through the management of derivatives, which are, and this is kind of the issue that's difficult to comprehend, is that the level of amount being exchanged is a lot larger than what's actually in circulation. So in numbers, it dwarfs the physical delivery of the items. And as funny as some of the contracts for derivatives have moved from having a physical delivery to having a cash delivery. So that they don't need to, because if you needed to deliver all the gold and silver that you sold, for example, you wouldn't be able to, because there isn't enough in the world to be delivered. Okay, so they what do? They do it with money. Okay, where do they get the money? Okay, they print it. So that's the system. This is why the dollar and other currencies have gone down since 1971 by over 90%. But over time, although they control it over time, these scarce items carry on going up in value because as market laws in the end, long term, will win all the time. Okay. Charanjit, maybe we can talk about AI next week. I think that's another long discussion to have. That I don't think is the best at the moment. It will take a long time to talk about this. Is go to Bitcoin stable? Go to Bitcoin at the moment. The one thing I can tell you, the price of anything depends from supply and demand, okay? But the one thing I can tell you that at the moment, gold and Bitcoin are pretty much the same inflation. So there is no physical reason for it to change. Over time, Bitcoin inflation carries on going down, and gold inflation probably will very, very slowly go up as the technology gets better to dig it out of the ground. But that's a kind of like a long-term progression. Okay, I think we've come out. We finished all the questions. Okay, so anybody has a last minute question before we end today's call? No? Okay. All right, so we'll finish our call here. We're going just over 9 o'clock. Again, Jonathan, if you don't mind, I don't know if your link has changed now. I just saw it on the Discord, so make sure that you put the new link there. And for those of you, I think most of you know Jonathan and have been on his sessions, but Jonathan does a very good Cardano-based session on 9:30. Are you doing it on Zoom now, or was it on Discord?
Yes. Yeah, so we're switching to Zoom. We've been having trouble recording the last couple of weeks, so for the next few, certainly it'll be on Zoom, so a bit more familiar for Zoom heads.
But it's still the same. This is still the same link, or
that is a new link, but it's a shortcut one, so that'll be the permanent link. Now it'll go either to Zoom or to Discord, depending on which one we're going to use. So feel free to keep bookmark that. Mm-hmm.
Fantastic. So I will say, I encourage you to go and follow your Fridays information session by joining Jonathan. You're just going. You have enough time to make yourself a cup of tea, maybe a slice of toast as well, and come join Jonathan for the Cardano session. Okay. So it will be less about the economy, more about crypto and Cardano. And you know what? There was one thing actually funny that we talked about it a little bit last week, but there was an article today talking about some of the metrics, in crypto, as like many people just saying about projects in particular, something that was going on about Solana last year and still going on now, talking about the speed, the speed of transactions, how that is kind of like an overplayed metric. And there are other aspects that are more important, one of these being security. And it is nice that the things that Cardano has been talking about for years, and if you listen to Charles Hoskinson, especially the founder of Cardano, often talks about, there are so many other things in blockchain that are more important than speed. Yeah, speed is important, but also there are other things that are important as well, because if we going to end up using this technology for elections, for the financial system and so on, security I think is pretty important. And now there's no way that at the moment the current technology you could run it on Ethereum, so just start thinking about these things for the project that you support. Okay, Cardano is one of the good guys, and that's why we talk about it so often. All right, okay, so I wish you all a fantastic weekend, and I'll speak to you next week. All right. Bye, everyone.
Thanks, Luca.